I think that's intentional. He hasn't intentionally closed the fund because he realizes as soon as he closes the first fund, all of those deferred payables that investors need to pay him are all of a sudden going to get realized by people, and people are going to go, what? That's how much you're charging me? Again, you go to an example like this, you invest $200,000, all of a sudden you're like, wait, your fees were 41 grand or more? I don't know if this is what the fees would be. You should evaluate that and demand what are the accrued fees that I've had being exposed to your fund. But I mean, if you look at this over a 10-year period on, let's say, the whole book, right? Let's say he could feed funds from one fund to the next, and he takes an AUM fee on $2.8 billion. Might even be more now. Some people say it's $4 or $5 billion. Let's just use $2.8 billion. $1 billion in equity, $1.86 billion in debt. And this is assuming that he's taking the fee on the full 2.8. Maybe he's not, but it depends on how much fund-to-fund lending he's doing. He gets an annual management fee of $28 million. Over 5 years, that's $142 million. Over 10 years, that's $280 million in fees. So in this scenario, on $1 billion of equity, he could make 28% in management fees alone. You know, people hear 1% and they're like, oh, that's not a big deal. Try that over 10 years. 1% acquisition fee, 1% disposition fee, 1% financing fee. And all of a sudden, when you go to the next page here, you hold for 10 years, you could actually see the fees could be 36.1% of that original investor equity. Now, that doesn't include a 35% waterfall after the preferred return, which could then generate more fees for him, depending on how much return there is left after all of the fees that he's deferred.